thank you so much to the Bitcoin Miner Summit for having us. I'm with Michael Saylor. Always an honor to speak with you, Michael. Thank you for joining me.
Yeah, thanks for having me, Natalie.
Well, I guess we'll start off with sort of the price falling again with Bitcoin this week. So what's your reaction to the current dip in the price and what it really means for Bitcoin mining companies?
I think that the crypto industry is going through growing pains, and over the long term, it'll be a good thing, but in the near term, it's a painful thing. There's about 90, what is the number, like 19,000? Let me pull this up. There are 19,839 cryptos on CoinMarketCap right now. And there's one Bitcoin. And that means there's 19,838 other things that are all thrown into the same bucket. So everyone in the marketplace and everyone in the mainstream media is trying to figure out what's the difference between Bitcoin and Ethereum, and what's the difference between Bitcoin and Celsius and Terra and Luna and DeFi, and what's a currency and what's a stable coin and what will happen to these things. And so at the micro level, a lot of learning and rationalization as the industry goes across the chasm from the entrepreneurial offshore Wild West roots to the onshore institutional public visage or public image that is about to become. And it needs to evolve and change in order for the big banks and the big investors and the big institutions to become involved. And there's a lot of uncertainty as it changes. So I see the industry is going through a very critical transitional period. And then if we overlay on that, the macroeconomic environment, which is just brutally painful, right? I think today the NASDAQ is down 362 basis points right now, which is extreme red, right? There's extreme red across all asset classes. It's a big risk off day. Swap rates are leaping. And so that's a lot of stress that's being placed on the entire financial economic system. And in the midst of all that stress, a couple of breakdowns, the famous one being Terra, but the secondary one being the Celsius breakdown that took place in the last few hours. Those are causing a lot of skittishness and a lot of panickiness amongst people that are short-term traders, or they don't have conviction. If you're a Bitcoin hodler, right, then all of this is just volatility if you have a long time horizon. But if you have a short time horizon, or you're trying to divine things week by week, day by day, then clearly a lot of anxiety in the air. And all of those things are a perfect cocktail for volatility.
Well, Bitcoin is really the phoenix that sort of rose out of the ashes of our last recession, our last financial crisis. So how do you think Bitcoin will perform in this one, especially versus traditional assets, the stocks, real estate, precious metals, and commodities?
Well, if I look back to the first of the year 2020, and I compare Bitcoin's performance versus everything else, I think it's 10x better than most conventional assets. So I think it's already been doing very well in the past few years. I think it'll continue to do very well. And the primary driver is going to be education. As more and more people understand what it is, as they understand a digital monetary network, and they understand its status as a non-sovereign store of value, deflationary, synthetic bearer instrument, right? As they understand that, then it's going to gain more adherence, and it's going to continue to monetize. It'll do it with fits and starts.
Well, one would argue if you are educated in Bitcoin, you're not selling. So who are the sellers right now?
Traders, right? I've classified all the people in the market as 5 categories. You've got the deniers, the skeptics, the traders, the technocrats, and the maximalists. The deniers and the skeptics don't put money into the market. They just hate on it. The traders are the ones that are attracted by the volatility of the market. And clearly they're having a field day today. If I look at Binance, the spot volume in Binance is $6 billion, which is triple, quadruple any normal day. In fact, this is probably one of the biggest days of the year, if it's not the biggest day of the year. So if you are a trader, then you want something with a lot of volatility that trades 24/7, 365, and they're going to trade the momentum of it. The traders, they'll trade it with risk assets as long as it's correlated to risk. So today's a risk off day, and they'll think it's a risk off asset. And on risk on days, they'll trade it the opposite direction. At some point, now the way they figure it out is not through thinking from fundamentals. Fundamentalist, the technocrats will look more at the fundamentals, and the maximalists will look the most. I can almost think if you spend 20, 30, 40 hours, maybe you can be a technocrat investor. And if you spend hundreds of hours, you'll become a maximalist investor. But if you're a trader, they're not going to spend more than a few hours. What they'll do is they'll run back-tested statistical models. And they'll say, well, we back-tested Bitcoin versus the NASDAQ index, and we determined that it trades with 3 times the volatility or 2 times, the amplitude, and then they'll adjust their models accordingly, and they'll look to arbitrage that. The traders have all the money in the market right now because the maximalists are all fully invested. They're dollar cost averaging. The technocrats will become more prominent, but right now the technocrats are investors, and all the tech investors are bearish. They're all afraid of everything, right? If Apple, Amazon, Facebook, Google are all trading down, the technocrats are in a bad mood and they're feeling a bit skittish. So the people in the market right now are the traders. They're always going to have more money and less fundamental conviction. But the traders, what they do is they provide liquidity. Right there, they'll expand the amount of asset in the marketplace, and then at some point, some fundamental investor, like some big technical investor, will go and buy $5 or $10 billion worth of Bitcoin and declare it to be a big tech monetary network. That will move the chart. That will break all the models. It'll modify the models of all the traders. The traders will then go, oops, it looks like it's negatively correlated to this, or it's correlated differently. And then they will unwind their trades, or they'll cover their short positions, and that'll cause a squeeze up. So, when you're a young investor, you hate the people that short your stock. When I was an early CEO, I used to hate the short sellers. But then I began to realize that people that sell your stock short are going to buy your stock. They've just got it in reverse order. So people that short Bitcoin will eventually buy back Bitcoin to cover the short. They've got it in reverse order. The danger is not the traders. The danger is having an asset that is of no consequence to anyone, right? That is not interesting. So the market's being driven by the traders right now. It's the most exciting market in the world. It's the only thing you can talk about on Saturday afternoon. It's the only thing you can trade on Saturday afternoon. And in times of risk off, when everybody's bearish, and everybody's kind of bearish right now because of Fed policy and inflation and fears about the future. When they're bearish, they'll act bearishly on the weekend, and they'll amplify that. But when that sentiment changes, then it'll work for us in the opposite direction. And even if it doesn't, I think it's just a matter of time before more of the fundamental investors come into the space, right? The life cycle is going to be the deniers will become skeptics, the skeptics will become traders, the traders will become technocrats, and the technocrats will migrate to maximalist, in the same way that water flows downhill. In the same way that people were originally skeptical of using steel and aluminum and electricity, but 20 years later, many of the skeptics had, buildings made of steel with electricity in them, and they were flying in airplanes with aluminum in it. So, so their progress can be counted on. The only real question is over what time frame? Is it 10 years, 5 years, or 20 years that it takes? And that's where, if you're a trader, right, the traders kind of want to get it right. If you're a maximalist and your time frame is 20 years, then it doesn't matter to you, right? You already know the answer. If you're an investor with a time horizon of 4 years, well, maybe then you're going to wait on the sidelines until you think that you're within 4 years of hitting your goal. If you're a trader, their time horizon is 4 weeks or 4 days. And so they're always going to be concerned about taking a big commitment no matter what.
Well, you know, Bitcoin has been such a beneficiary of this QE environment that we were in for so long. And obviously, Bitcoin adjacent companies, Bitcoin mining companies benefited from that as well. But now that we're entering into this tightening mode, how do you see this really playing out in terms of Bitcoin becoming an uncorrelated asset? Because right now, mainstream media says it's all correlated. Equities are falling, so Bitcoin falls. It hasn't fallen as much as some stocks have. I think it's outperformed them. Hasn't fallen as much as it has in previous bear markets. I think it's down in the 60% range as opposed to in the 80% range when it fell in like the 2017, 2018 bear market. So when will it be a really truly uncorrelated asset or an inflation hedge?
I think this is the decade that it institutionalizes. So we're 2022 right now, and I think over the next 8 years, you see it progressively every year move from being a speculative, risk asset to a less speculative store of value, bearer instrument. It'll probably take that long to mature. I got a set of milestones, right? There are the regulatory milestones. If FASB addresses the accounting issue and gives it fair value accounting, that would be a step in the right direction. That's one milestone forward. If the SEC approves a spot ETF, that's a second milestone. If they approve a dozen, that's the third milestone. If Senator Lummis's legislation gets finalized and approved and provides a sort of regulatory framework for cryptocurrencies, crypto property, crypto securities, crypto exchanges, et cetera, that's another big milestone. I think the FDIC providing guidance to banks would be another big milestone. I think that there's an entire class of traders that are entering the market right now that are getting comfortable. Every day you read a story about Citadel trading or Goldman Sachs trading. 2 years ago, even a year ago, they wouldn't have. So as they get more involved and as big banks offer coverage, like now you see Bank of America and Citigroup and others offering coverage of the space, I think that's another milestone. So you'll see a lot of those kind of regulatory milestones. I think a lot of the states, as they start to embrace Bitcoin mining, they create a degree of clarity to it. And then you've got on the other side, the institutional investors. And I think that as you see investors take very big public positions in the Bitcoin marketplace, that establishes a sort of milestone. And as the Bitcoin miners mature and get stronger and continue to come public, that's another milestone. So there's a never-ending parade of those milestones. Each one of them seasons the asset class or matures it. And as you can see, it's 2, 3, 4 years of excitement, followed by another 4 years of people just working their way into these positions. But I think by the time we get to the end of the decade, you'll have 90% of the regulatory clarity people would like, and you'll see a much broader base of public companies and institutional holders and institutional supporters and organizations that are maturing or providing support for the entire network. I didn't mention one last thing, which is the companies.
Mm-hmm.
Companies like NYDIG or Fidelity, right? As they provide support for banks and for 401ks, and as they provide custody relationships and banking services, companies like Silvergate. as those companies start to offer their applications, all of those things cause the network to mature and stabilize, and they reduce volatility,
Mhm.
and they encourage the public to transition their view of this from a speculative asset class to a store of value network.
Yeah, no, that's a great point. I remember your tweet where you kind of touched on the different tiers of Bitcoin, the Bitcoin network, and these different layers as they grow. But I want to talk a little bit about Bitcoin mining and energy costs. We had a CPI inflation print 8.6%, but energy costs skyrocketing. So there are a lot of almost macro forces that are converging that are against Bitcoin miners. Energy cost inflation. Obviously, miners are huge energy consumers. So as the costs go up and as the price of the asset and revenues fall, it almost feels like a perfect storm. So if costs keep going up and Bitcoin keeps falling, how do you see that playing out? And how do they hedge?
Um, if you have antiquated mining equipment, then your Bitcoin mining is electricity intensive, right? So if you're running at 99 joules per terahash, you need to buy a lot more electricity than you're running at 30 joules per terahash. So the older mining rigs and the older mining companies have to have extremely cheap equipment, or sorry, cheap electricity, and their break-even points, right, are different. They're lower. At some point, if you don't get 1-2 cent electricity, you can't stay in business. The newer mining rigs have a much higher break-even point because they're much less electricity or energy intensive, and they're much more technology or capital intensive. So as you know, as this evolves, I don't think I don't think that the increase in the price of energy to consumers is a first order issue for miners, because most miners have relocated to the edge of the power grid, and they're sort of running off of stranded, recycled wholesale energy that nobody wants, right? That's where you would go if you're a miner. So if you're going to be a miner, you have to have these long-term electricity contracts that lock in an extremely favorable price. You would never sign 10 cents a kilowatt hour contract. You would go for 2 cents or 1 cent, or you would look for someone that literally wants to give you the electricity for free because they see other benefits to doing it. So really what happens is, as the Bitcoin price comes in and as the network gets more competitive, as the hash rate grows, if the hash rate doubles and the Bitcoin price is cut in half, it squeezes all the miners running antiquated equipment, or the third generation equipment, and they'll just get squeezed off the network when their break evens, or when their electricity cost, is above the break even point. And you would expect that, you almost have like these bootleg miners that are sitting in jurisdictions where they're literally getting free electricity. Like in China, it wouldn't surprise me that there weren't miners getting literally zero cost electricity. They were given the electricity by the province as local businesses. So occasionally you'll see some of those businesses continue on old equipment. But if you're operating in Western Europe or the United States or North America, any main Western regime, then anyone running on obsolete equipment is just going to shut down in difficult times. In really, really good times, if the Bitcoin price skyrockets, like when it skyrocketed to 60,000 a coin, people actually do the opposite. They bring online antiquated Bitcoin mining equipment because the break-even point has risen above their cost of energy. And I'm not bothered by the network dynamic, because the network is in essence self-healing and organic and naturally healthy. When you take all this in, the conclusion you come to is the network is moving from being energy intensive to being capital intensive, but it's not any kind of capital. It's SHA-256 hash capital, or another way to say it is, if you didn't have ASICs, you would need a lot of electricity. but the better the ASIC, the less electricity you need per exahash. And in the extreme, if you go out another decade, it'll be all about the ASICs. So the competitive dynamic in the marketplace is shifting from who can get the cheapest electricity and where can they get it, to who can get their hands on the best ASICs, right? The best semiconductors. And and then how fast will the semiconductors improve? So if they improve fast enough, right, and if they're good enough, then the electricity is less important. It'll never be not important. I mean, if I'm looking at the ways that you can fail as a Bitcoin miner, one way you can fail is you can't secure electricity at 2 cents a kilowatt hour for the next decade, or the power provider reneges on their deal, like what we just heard about in Washington State, and they just jack the price on you, right? And that's happened in the history of Bitcoin mining a number of times, where they secure a certain deal. If it's a short-term deal, well, that's like kind of setting up a restaurant with a 1-year lease, and the restaurant's a screaming success, and then your landlord triples the price of the lease and you're screwed, right? So short-term electricity contracts can undo you. A long-term contract, though, it still has counterparty risk. You could sign a 30-year contract, but if it's with a non-trustworthy counterparty and they renege on the deal, you're still screwed. So the first challenge is secure the energy supply. The second challenge is secure it in a politically supportive jurisdiction. You can have the energy supply, but if the province or the country triples the price, the tax, or passes an anti-Bitcoin law, right, you're still out of luck. So you have to navigate that risk factor as well. If you manage to navigate those two risk factors and manage them, and by the way, you can't be 100% certain of anything, right? So that means that if you're running a Bitcoin mining company, you would be wise to diversify your mining centers across multiple political jurisdictions and multiple energy providers, assuming that you're going to have a counterparty failure, right? Someone is going to disappoint you at some point, and you'll have to relocate your mining rigs or relocate your operation. So you have to be thinking about those two things. But then the third thing is, can you actually maintain a modern semiconductor infrastructure? If we get to equipment that is running 20 joules per terahash and you're on 100 joules per terahash, you're not competitive. But what if someone comes up with a 5 joule per terahash, a chip, or a 1 joule per terahash chip? And so there's that. And of course, there's the countervailing risk that what if you buy into a new vendor that promises you a 10 joule per terahash chip, and then they don't deliver and they keep your money? So Bitcoin miners are businesses. They really are the line of first defense of the network. They are like the skin of Bitcoin, just like your skin takes the infection first, and it's part of your immune system. And if you didn't have a skin, right, then the rest of your immune system probably couldn't save you. Bitcoin miners are that line of first defense for the network, and the way that they defend the network is the same way that a crumple zone in your car defends your structural integrity. You don't defend the network by being rigid. You defend the network by crumpling or by failing. So you can see where certain jurisdictions turn against the network, like China. Right. And so, yeah, we lost 40% of the hash power for a while. Right. And then you can see when energy providers turn against you, and you see lots of examples of defaults of Bitcoin mining rig manufacturers where they promise something they can't deliver it. And the reason that none of this is really threatening to the Bitcoin network in general is because the Bitcoin miners are fighting a battle to defend the network 4 years into the future. So the network is perfectly secure now, and it's possible the Bitcoin miners will be attacked, but Bitcoin will be fine. And of course, if all of the miners are attacked everywhere consistently for a decade, then we probably have a problem, right? But if there's an infection of the Bitcoin mining network and it's affecting 5 or 10% of the miners, and it takes 2 or 3 years to run its course, right? The network simply, reconfigures itself to better power sources, to more reliable semiconductors, and to more reliable political jurisdictions in order to maintain the security and the integrity of the network over the long term. So, summary, owning Bitcoin is easy. Running a Bitcoin mining company is hard. The Bitcoin miners pay in capital, in stress, right? They pay with their attention to duty, right? Continual operational engagement in order to provide the security and the integrity of the entire Bitcoin network. If you want a full-time job fighting in defense of Bitcoin, then you become a Bitcoin miner. And if you want to retire comfortably and not worry about your money ever again, you become a Bitcoin hodler. And they really are two extremes, right, in one ecosystem. And of course, they need each other. But it would be a mistake to think that owning a Bitcoin miner is just the same or as safe as owning the Bitcoin. It isn't. Right? There's potential upside and there's potential downside. And it's easily, if it's 1,000 times as complicated, I might be understating it. Bitcoin miners are securities. Bitcoin is a commodity or property. And we say over and over again, securities are complicated, full of risk, and they're an investment that you can lose everything or you can make a lot. And you can make the right decision with the wrong timing. Like you could pick the right miner, but have bought the stock at the wrong time and you can lose money, right? That's the characteristic of securities. And you're dependent upon the efforts of others that may delight you and may disappoint you. Whereas Bitcoin is a property, a commodity, and you're really you're investing in a much more complicated, decentralized ecosystem that is self-healing.
Very true. I always appreciate your metaphors, Michael. What do you think is the most misunderstood aspect of maybe the business of Bitcoin mining or that economy?
The most misunderstood aspect. I think that to the outside world, some people think that it's energy intensive, and it's really not. It's technology intensive. And it's becoming more technology intensive. So I think that people don't realize that success is a function of raising capital to acquire technology. And it's also, if you're going to be successful, you have to be good at raising capital. You have to be good at acquiring semiconductors. You have to be good at building and operating Bitcoin mining centers. And you have to be very politically astute, both in getting the support of the public sector. And also you have to be very vendor astute at getting the support of your power provider, your electricity provider. And so ultimately, all of those things are what make you successful, I think, as a Bitcoin miner. The outside view is, oh, Bitcoin is just secured by energy or it's secured by electricity. It's actually secured by ingenuity, right? And entrepreneurial ingenuity at that. I think the other misnomers are that people keep thinking that that this is about it's about doing transactions, but of course, Bitcoin mining is really about generating security and integrity for the network. And another interesting misnomer, they keep saying Bitcoin's not backed by anything, or they'll say it's backed by energy. What they don't realize is the Bitcoin network is really backed by about $20 billion of special purpose hardware, proprietary capital, and you're feeding $20 billion worth of energy into that proprietary capital over the course of 4, 5, 6 years. So there's an extremely large, a large amount of hash capital or computational capital that the Bitcoin miners secure and provide. And you can value that. You could probably value all the SHA-256 hashing over the next 6 years, like the useful life of, you could sort of value the network over a time horizon of 6 to 8 years. And if you actually calculated that value, how much money, what's the replacement cost of all the mining equipment, plus all the additional equipment which will be installed, plus all the electricity which will be acquired. You put all those things together, you're going to get to a number which is somewhere between 40 billion and $100 billion, something like that. And then you could ask the question, well, so if that is the security budget of Bitcoin, then what is the security budget of the next best thing? Right. And if you start looking at it like that, then I think you start to realize that Bitcoin really is unique and irreplaceable.
And can't easily be replicated, like so many people argue. But we've also seen recent examples of Bitcoin mining operations being harnessed to strengthen and stabilize the power grid, right? In places like Texas, we saw that this past week. So how important of a role do you think Bitcoin miners will play just in terms of the future of energy supply?
I think you could think of Bitcoin miners as shock absorbers for the power grid, right? It would almost be irresponsible for you to roll out a power grid without shock absorbers or the like. Just like it would be irresponsible to create a car, without shock absorbers or the appropriate springs. I think that people are gonna gradually understand this better. It's pretty clear that Bitcoin miners are strengthening the power grid wherever they are, because they're big buyers of marginal electricity that has no other buyer. So they're increasing the marginal revenues of the power companies. And in times of stress, like the heat wave this week in Texas, they're the one buyer that can power down quickly and in an agile fashion. So if I was building a power grid, I would want to have a Bitcoin miner as part of it, in the same way that you would want to put a battery or a capacitor of some sort in any electrical system in order to avoid wasting energy. So another phrase that pops to mind is reservoir. Every utility system needs a reservoir. I mean, imagine having a water system in a city and no reservoir, right? Which means that you have to exactly synchronize the water coming from the external source with the consumption of water, and you can't deal with any volatility. So Bitcoin miners really are the reservoir of a power grid. I'm hard pressed to think of another thing that serves as a reservoir of power. And if I could think of another thing, it would be probably 100x more expensive, or like if I just went and bought a huge battery of skyscrapers with batteries in them, and I plugged them into a power grid, it would be fiendishly expensive, and batteries are fiendishly inefficient. And so there's no way that you would want to use lithium-ion batteries as the reservoir for a power grid for the city of Dallas, right? And unless you're selling those batteries, right? That company might like the idea, but I think Bitcoin miners are critical, and they're going to continue to expand in that way. and everywhere where there's renewable energy, especially where people are using wind and solar, which are extremely fragile renewable energy systems, I think you're going to need to pair that with Bitcoin mining in order to have any hope of resilience in the network.
Well, I want to talk a little bit about just policymakers and their takes, their views on Bitcoin mining. There still needs to be a lot of education that happens in that realm. This month, the New York Senate passed the first bill in the US that would ban proof of work mining operations, that 2-year moratorium on new POW mining projects powered by carbon-based energy sources. What are your thoughts on that? That's a really hot topic in this industry. What do you want people to know?
Well, I don't think it's quite as bad as banning proof of work. It's more like wrapping a bunch of red tape around the expansion of a proof of work facility based on a carbon electricity source. So it creates more headaches for the fossil fuel factories. If you're going to do any Bitcoin mining or Bitcoin expansion, if you're going to expand a Bitcoin miner in New York, the obvious answer is you're going to do it with renewable energy from this point forward. So it's more of a marketing debacle for New York than it is an inconvenience for Bitcoin, because it makes New York appear to be unfriendly to Bitcoin. But if you're a miner operating outside of New York and you were to enter New York, you would obviously only do it with a long-term contract with a renewable power source. And if you're in New York, you're going to have to convert your growth toward renewable power sources. I don't think it was a wise bill for obvious reasons, and at the same time, I don't think it's going to have that much impact one way or the other on Bitcoin mining in the rest of the world. And I think in time, you can expect that people are going to fight political battles. Most of these political battles are one competitor trying to undermine another competitor by getting some kind of asymmetric rule or prejudicial rule passed that advantages them over their competitor. This was just a minor, I call it a third order example of some of the crypto proof of stakers wanting to make life inconvenient for proof of work miners in New York. But it's such a third order thing that I don't think it has much impact long term one way or the other. And I think it's more important for us to focus upon first order issues. The first order issues are just understanding the difference between digital commodities and digital securities, and the impact of legislation like the Lummis bill, how it will impact the entire crypto industry. And even more important than the legislation is the most important thing is just educating the general public on what is Bitcoin and why is it a rational thing. So the education will drive intelligent regulation, and the regulation of the asset class and the normalization of the asset class will accelerate institutional adoption. And in the periphery, you'll see various provinces jockeying back and forth on the periphery over these things. And you can fixate on them, but probably they could be a distraction too if you're not careful.
I want to touch on that Lummis and Gillibrand bill just a little bit more, because you've often said in public that Bitcoin will benefit from regulatory clarity and when the altcoins are deemed securities. And right now there seems to be more of an accelerated push for that regulation. We just had that legislation introduced, the Responsible Financial Innovations Act from Senators Lummis and Gillibrand. So what do you see happening from a policy perspective, maybe in just the next year, and how will it really facilitate more adoption from traditional banks and the public companies and institutional investors?
Well, I think that the world needs a clear definition of a digital currency versus a digital commodity versus a digital security. And the world wants stable coins, but they want stable coins that act like dollars that move at the speed of light on computer rails. And so one could say, well, maybe the closest thing they have to that right now is the Circle coin if it's fully backed. And Tether is opaque, so people aren't sure because it's not clear what it's backed by. And then UST wasn't really backed by much of anything. So if there was a fully backed normalized stable coin, that would be a digital currency. It'll have to meet banking guidelines. And so an FDIC insured bank that issued that thing would probably grow that market by a factor of 10 to 20 in a hurry. It would go from 150 billion to 1.5 trillion or something. That will be good, because there's still a lot of people in the crypto market that think that somehow Bitcoin is a risky thing to hold as long as Tether might crash, or as long as UST might crash, right? And, maybe they're not wrong in the near term. Over the long term, I don't think it matters. But in the near term, when there's instability with a digital currency, it creates instability with a digital commodity like Bitcoin. The meltdown of Terra kind of introduced an entire generation of crypto bros to the idea that there is a difference between a security and a commodity. Everyone wants to treat these things the same, but I noticed people on crypto Twitter tweeting that we need more disclosure from all those coin teams, et cetera. It's kind of a laughable thing, because of course the whole point of a security is securities have risk factors, and that's why you have to take the company public, and that's why you have to publish 100 pages of disclosures, because the only way you can ethically and properly promote a security is when you make full and fair disclosures. So I think these meltdowns will accelerate the transition of the industry to appreciate that securities need full and fair disclosure, and most of all the crypto tokens are all securities. Like 99% of them securities might be understating what portion of them are security. I think the number is more than 99%, right? Out of 18,900 things, there's a debate over a handful of things that might be commodities. Everything else is a security. And the reason it's a security is pretty obvious. If you understand the law, or you understand the Howey test, they're all centrally managed by project teams, and they've been issued pursuant to ICOs with pre-mines and anticipation of a profit. And there's always a team of people that have influence, either over the reserves or the protocols, and having these decentralized governance tokens, they're not decentralized. The DeFi exchanges are not decentralized. It's pretty obvious they're not decentralized. If one team of 3 people can put forth a proposal to everybody else in the community, and there's only 2 choices, do you want us to go left, or do you want us to wait a month and go left? Well, that's not decentralized. That's an example of a corporate board proposing a shareholder resolution where your choice is to elect them or wait a year and then elect them, right? So I think this is pretty obvious to people in the mainstream investment community that understand securities law. But I think the crypto people just don't understand it. And now there's like $1 trillion of drawdowns. I think people are being encouraged to understand the difference, and they understand the risk factors. So it's the writing on the wall is clear here. The exchanges need to be regulated. The crypto tokens are securities, and there needs to be full and fair disclosure, right? If you're going to issue a currency that's going to be used as a medium of exchange, it needs to be trustworthy, and whatever's backing it needs to be disclosed. If someone told you that they were going to give you a currency that was backed 110% over collateralized by dollars in a bank in New York City and JP Morgan, then you might look at that differently. Then you're just having to trust the bank, whatever it is. If they said it's collateralized by my collection of NFTs, it's like, well, how liquid are those? And what are they worth? Right? It's a different thing. If you're going to use something like as collateral and it's viewed as risky, you need to over collateralize. Right? MicroStrategy over collateralized our Silvergate loan by a factor of 20. And there's still massive angst over that. But you can see the way that we deal with the angst is we disclose in SEC filings every single word, like all the details of all the loans and the balance sheet, and hundreds of pages of disclosures, including dozens and dozens of risk factors. And that's the way that you do it in a mature securities environment. So the industry is not really mature yet. There's a lot of work that needs to be done to get it mature. The world doesn't need 19,800 cryptos. It needs one. We know we need one. The world clearly wants a digital dollar, and it wants a digital commodity like a Bitcoin, and it wants a set of exchanges, a way to buy and sell them and swap them and move them. And then the world would probably like a lot of banking services, loan services, yield services on top. But constructing all these things requires a lot of work and a lot of disclosures. And if you run fast and loose, if you just do it quickly, sure, you can stamp out 19,000 securities if you don't take any of them public. It's just quick and cheap. And if you want to offer a yield product, you can do it much quicker and cheaper. But the result is massive risk that you can't properly assess, and potentially systemic fragility in the system. So I'm in favor of what's happening. I think ultimately we need less complexity, more transparency, and more clarity. And as we get that more clarity, I think ultimately that's really good for the crypto industry in the US. It will grow. Like if there was $5 trillion of US dollars in stable coins circulating, that would be better, right? The world could use that. So there'll be more of that. It'll be good for the dollar. It'll be good for the US. It'll be good for the crypto industry. It'll be bad for a bunch of entrepreneurs that have been cutting corners, and anyone that can't cross the chasm. It's like at some point you can't take your company public because you can't get decent lawyers and accountants to work for you, and you can't collect your thoughts. And if you want to go public, you need systems. You plan 3 years in advance, and the systems are accounting systems just so you can figure out how to explain to your investors what you have and what you are. So there's a lot of that work that needs to be done. Ultimately, it will cause a shakeout, and there'll be a lot fewer providers, but the quality of what they provide will be better, and it will be integrated better into the public policy framework. And Bitcoin will rise because right now it suffers from guilt via association with a lot of these other scams and altcoins and whatever they might be. Right? There's an old saying in the used car business. What's the difference between, how do you say this? A software salesman and a used car salesman. That's the joke. It's a software joke. You know what the answer is?
No.
What's the difference between a software salesman and a used car salesman? The used car salesman knows when he's lying. Okay. And it alluded to the idea that software is too complicated. So the people selling the software don't even know what it does. And when they tell you it'll do something, they're wrong, but they don't even know they're wrong.
Right.
So you could apply it to crypto as well, where most of the people selling all these crypto things don't even know when they're lying. They just, because it might take you 10 years to figure out all the nuances. And because they're in such a hurry, right, it doesn't occur to them how many rules they broke. Like for owning the token that you promoted, that then you have influence over the protocol of that you ICO'd, right? And then selling it because you have a disagreement with someone else over the protocol. It might not occur to you that that could be deemed as a securities fraud.
These are such great points. Yeah, you're such great points. And, it's amazing to think about how this could really be like a free market system where things do fail and other things rise through aggressive competition, which I feel like we haven't had in the traditional world in a while. But as we start to wrap up, I wanted to ask you, what do you think are the biggest challenges facing Bitcoin mining companies today? And how do you think they should be addressed?
It's clear the hash rate will keep going up. I think it's been going about 75% a year for the past 5 years. So I think that the number one thing is you have to model out your expectation for how the hash rate's going to evolve over the next 5 years. Then you have to look at your own mining facility and your balance sheet and your capital investment plans. And you have to consider how stable your mining centers are and how reliable your source of energy is and how reliable the political jurisdiction is. And if you work all that out, you can come up with a plan and a model for what you're going to do and then do that thing. Ultimately, I think that the industry is going to be dominated by those that are able to get their hands on the highest quality mining equipment and put it into production. They're going to have economic advantages over everybody else. But between now and then, the industry is kind of rife for consolidation. I think that lots of small miners will probably be merging or be bought up by the bigger miners. I think you got to decide whether you're going to be one of the consolidators or one of the consolidateds. I think ultimately, you don't want to be a small private company doing cash mining for the next decade. I think you're going to have to figure out how to get public, how to raise capital, and do you do it by merging with a public company, or are you big enough to be that public company?
Has MicroStrategy considered mining Bitcoin?
We considered it, but as I said before, owning Bitcoin is the easiest business in the world. Mm-hmm. And mining Bitcoin is I'm not going to say it's the hardest business in the world. It's a very hard business in the Bitcoin ecosystem. One of them is extremely competitive, getting more competitive, and anybody can enter the business. That's how the network becomes open and permissionless. Mm-hmm. The reason the Bitcoin is ethical and the reason it's a commodity is because the Bitcoin mining business is a competitive business without any obvious proprietary barriers to entry. And so you have to be prepared to compete. And you have to assume that if I have $1 billion of Bitcoin, it's an appreciating asset. If I have $1 billion of Bitcoin mining equipment, it's a depreciating asset, right? And the debate is how fast is it going to depreciate? And did you buy it at a price that allows you to recover your capital before it depreciates? And these are very complicated questions, right? Because it's a function of where you are and your tax rate and your energy and your access to the capital markets. And there's some uncertainty there. So we don't do it because it would change the nature and the character of our company. And it would take our company from being a very simple company. We own 129,000 Bitcoin. What do you think Bitcoin is going to be worth in 5 years? It's that simple. To a very complicated company.
Yeah.
Right. What will we buy will Bitcoin mining rigs be 2 joules per terahash in the year 2028? And will we be able to buy any? Right. And how much will be manufactured in that year? Those are big questions. I don't have the answer to that question, but if you're a public company, it behooves you to be transparent and to be understandable. So if you're going to be a Bitcoin miner, you should be a Bitcoin miner because then the investor community will want to buy the best Bitcoin miner and they'll be experts on that. If you're going to be a Bitcoin holder, you want to do that. What you don't want to do is be half miner, half holder, half software company, and then evolve your strategy, because now the investors have to guess, right? It's too hard to guess. Just like we don't hedge our position, because if we hedged our position, they would have to guess whether we will continue to hedge our position. If we diversified, they'd have to guess what we're going to diversify into. And when you make it difficult for someone to know where you stand, they can't put any weight on you. I would invest $1 billion in Bitcoin if I wanted to buy Bitcoin, but I wouldn't invest a nickel in a hedge fund that buys a mixture of altcoins and some Bitcoin.
Yeah.
You see, like, it's not worth anything to me.
Mhm.
Zero, right? Less than zero, right? Right. What I want is someone that's reliable and dependable, that I understand. If you want silver miners, you buy silver. You want copper miners, you buy copper, right? That you buy what you want to buy. So it doesn't really make sense for us. It makes a lot of sense if you're a private Bitcoin miner to come public. That makes a lot of sense,
Yeah.
right? If you happen to have, if you manufactured Bitcoin mining rigs and you had billions of dollars of Bitcoin mining rigs, it might make sense for you to get into the business. You have a proprietary interest in it. So everyone should sort themselves out.
Well, speaking of miners that go public, are publicly traded mining companies under a greater threat because of government regulation or the ESG narrative?
I don't think the ESG narrative is that threatening to them, because for the most part, all the publicly traded miners are focused upon sustainable fuel sources. If you're going to operate on a different fuel source, you have to do it in a political jurisdiction that's supportive, right? And so since we're currently in a political jurisdiction, say North America or the United States, which is very focused on sustainable energy, it just makes sense to align your company with the politics, of the country that you're within, and that naturally works itself out. I think that the public companies have a big advantage in cost of capital. They have a political advantage too, right? If you want a supportive state, and if you want supportive investors, then people will support you more if they feel they can trust you. Public companies are the most trustworthy, they're the most credible counterparties for a bank or for a politician, right? Why are they credible? Because they have armies of lawyers and armies of accountants. And before I do anything, I ask my accountants and I ask my lawyers. And then if we do something, we disclose it.
Mm-hmm.
And that gives a mayor or a governor or a politician or an investor, right, a lot of comfort, or a banker, right?
Mm-hmm.
So it's advantageous to be public because you're a more creditworthy counterparty. And Bitcoin mining is a capital intensive industry. So a couple of things you need the trust of the vendors who sell you the semiconductors. If I place a $500 million order with Intel, what if I default on the order? Right. So Intel would rather have the $500 million order from a public company with a multi-billion-dollar market cap than from a private company, because they don't know whether the private company has any capital or not. But public companies, they know. So being public helps you to acquire that equipment. And so a lot of time, the reason the hash rate is shifting to North America and to the US right now is because of all the Bitcoin miners that came public in the US that are buying up all the modern equipment, because the vendors want to sell to the publicly traded companies, right? There's a backlog of equipment. There's a shortage of equipment. They're going to ration that equipment, and they're going to ration to the most creditworthy counterparties. Likewise, right? If you're running a publicly traded Bitcoin miner and you go to a governor of a state and you want a meeting, you're a lot more likely to get it. Whereas if you're running a private miner that may or may not have any money, that may or may not be big, that might not exist at all, it's much harder to get the same meeting. It's harder to get the press. It's harder, employees want to work for public companies, not private companies, right? So the deck is stacked in favor of trustworthy entities. And just like Bitcoin is the most trustworthy commodity network, people are going to trust securities that are public. Public securities are more trustworthy than private securities.
Mm-hmm.
If I ran a private company and I offered you 10,000 pages of documents on my finances, that would not be as trustworthy as if I run a public company and I say, these are the 10,000 pages I filed with the SEC, right? There's a lot of obvious reasons why, but you can see there's a the deck is stacked against small companies over large ones. It's stacked against private over public. It's stacked against foreign operators over domestic operators. So I think that the network will continue to grow and the hash rate will continue to move toward public entities. And there'll be consolidations. And I bet a bunch of public companies will buy a bunch of private companies, and probably some public companies will merge with each other because that makes sense too. But I'm not really concerned about the centralizing effect. The network overall is decentralizing more than it's centralizing, and power is being diffused more than it is being concentrated by all of these things.
Yeah, you're right. Michael, I get so excited even learning about this industry because I really think it's about building the future of the security network for the future of money. And I think it's so important to understand the infrastructure, the economy. So when you think about Bitcoin mining, long into the future, into the next couple of years, decade, what do you get most excited about?
I think Bitcoin miners are digital energy producers, right? A mining center is in essence producing and securing digital energy, right? And the innovation of Satoshi, sometimes people say it's solving the double spend problem, or then they say, well, it's transfer of value between two parties without a trusted intermediary. But that so understates the real innovation. The real innovation is the creation of something of value in the digital realm that could then be transferred. But the existence of $1 billion of value without a trusted intermediary is much more impressive than me sending it. The existence of it, because without Bitcoin miners, $1 billion is credit, and it represents a ledger entry at JP Morgan, or Visa, and if Visa disappears, the money disappears in cyberspace, and JP Morgan disappears, the money disappears in cyberspace. So the people, they misunderstand what Bitcoin miners are doing, right? Ultimately, they're not just clearing the transactions and they're not mining Bitcoin. What they're doing is they're creating a digital energy network. And this is not different than, it's not different than creating like an interstate highway system. Well, why did I do that? I did that so I could drive a car from New York to San Francisco in 3 days. How valuable is it? Well, what if I put something worth $1 billion in the car? Like, what if I put something worth your life in the car? What if I put something that's going to save your life in the car? Well, it's infinitely valuable because it's a container to move something of infinite value. So Bitcoin miners are they're really the foundation of the entire digital economy once you understand it that way. And if I can create blocks of digital energy, right, then I can create cities made of blocks of digital. I can create anything of value in cyberspace that I can then move friction free. I think, I looked at the transaction cost. They're literally 1 basis point for value transferred right now. That's how efficient it is. And the Visa network is 200 basis points. So, and it's only going to get more efficient. So the magic here is like, if I look for a different metaphor, it's like, imagine I had like 100 towers and they're all slurping in electricity, and they're all shooting this teleporter beam into orbit. And because those 100 towers exist and they burn a few $1 billion of electricity a year, you can now move anything of any weight into orbit or fetch it back again for free. Like, what if I could move all of New York City for free? Right? I'm achieving weightlessness. And so you would want to keep those 100 digital energy centers running, right? If they were the 100 portals to every star in the galaxy, and you could just step through the teleporter to any other solar system, and it was instantaneous and it was free, right? It's the basis of civilization, right? And that's how I see it. I see them as portals, caissons, the foundation of the entire cyber economy. When we created airports and we put an airport in New York and an airport in Tokyo and the 747, we connected New York and Tokyo in 12 hours, and you could step into one side of that portal and step out the other side, and you connected the cultures, right? And it's totally, world bending, earth bending, right? That's what Bitcoin miners are. They're connecting us. They're connecting the matter and the energy of the physical world into matter and energy in the digital world. And if you get it into the digital world, right? Once you get New York City into orbit, you can move it for almost no energy, right? And it'll last forever. And that's what you can do with something constructed of digital energy. It'll last forever, and you can move it. You can oscillate it at any frequency, and you can move it at the speed of light or faster, right? And you can program it. So ultimately, this is the basis of the 21st century economy. And not every Bitcoin miner is going to succeed in their business plan, and not every jurisdiction will be favorable. But it's kind of like if you said to me, Mike, there's a bunch of islands in the Pacific, and there's one of them with an airport where you can land your plane. And there's 100 other really good islands, but the people that live on the island, they passed a law making it illegal to build an airport. Now, where do you want to go? Like, I think I'm going to fly to the island that's got the airport and enjoy this, right? The sands there. There's a lot of other places on Earth that if you can't land on the runway, you're not going there. But Michael, aren't you concerned that there's some island in the Pacific with a great beach where they're going to outlaw airports? I'm like, yeah, but they're lost. Like, it's unfortunate for them, but ultimately, at the end of the day, there's a lot more sandy beaches than there are islands in the Pacific with good airports that'll take an international flight, right? And at the end of the day, there's going to be a lot more energy sources, right, than we need to run the entire Bitcoin network. The mining network will distribute to the best places. It's critical to the civilization. It's people completely underestimate what it means to create a digital commodity. It is, in essence, the future of the commodities industry, the future of the energy business, the future of the technology business. And we've just barely scratched the surface on the value propositions. I'm sure that the Bitcoin miners will go through evolutions here. And also, I think, Natalie, I think they will evolve as the Lightning Network evolves. I wouldn't be surprised if Bitcoin miners don't find themselves as infrastructure providers for the economy. And there's other opportunities like running Lightning applications or Lightning nodes or the like. And so just like everything, you get into Standard Oil got into a business and they were offering heating oil, or lamp oil, and then it was heating oil, and then it was oil to operate small machines, and then it was oil to operate automobiles, right? And the business evolves as people understand how to use that energy. I think the Bitcoin mining industry will evolve in the same way.
Well, thank you so much, Michael. As I mentioned earlier, it's such an honor to speak with you. I appreciate the chance, Bitcoin Miner Summit, for allowing me to interview you again. And, any final takeaways?
I think times right now are a little bit tough on a lot of people, but I'm not terribly concerned that it'll last too long. We'll get through this, and then there's going to be a lot of new explosive opportunities on the other side. So I think the key is for everybody to hunker down, grit your teeth, and work through the difficult times. And keep your eye on the future, because the future is putting $100 trillion onto the Bitcoin network and then building first hundreds, then thousands, then tens of thousands of interesting applications on the layer 2, the layer 3, the layer 4, the layer 5. And as that happens, there's going to be a lot of opportunity for everyone. We're just going to have to live through times that are right now somewhat difficult, with a lot of critics who lack imagination.
Very true. Well, we're very lucky to have you as the voice of reason, especially during these volatile times. So Michael, thank you so much. And to the Bitcoin Miner Summit, thank you.
Thank you.